Testing. See if we are live. So yeah, welcome to the first live stream of Daily Dose of Dividend. Usually I do these short flashcard videos for you guys, but today I thought we could take a look on some REITs. I had a lot of questions if we could do some valuation on REITs. And the scorecard I have for evaluating the ordinary stocks doesn't really fit for REITs because they have a bit of other type of earnings. So like PE and debt is not really applicable on REITs. Also, they tend to increase their shares a lot to fund their expansion. But yeah, let's take a look at some large REITs. I was thinking we could go with top 10. I found a nice article here by the Visual Capitalist. And it has listed the 10 largest REITs. The article is a month ago, April, by Marcus Liu. And I like these graphics he made. So yeah, the values might have changed a bit with the market cap and the dividend yield, but the fundamentals of the companies and what they do and in what type of REITs they are probably hasn't. So I think this could be a fun moment for us to learn more about REITs. Just gonna move this over here. See, there's a watermark over my face. I'm not sure if it's there in the stream also. How do I check that? Maybe if I log into the stream myself on my phone. So just log into the stream myself on my... Okay, no, it's not there. It's just in the preview on the YouTube streaming software. It's good to know. Anyway, 10 largest REITs. And let's take a look. So number one seems to be Prologis, an industrial REIT, $116 billion in market cap. And I guess their business is booming with the e-commerce industrial needed for the warehouses and so on. I'm not too familiar with this REIT. And for you who don't know, REIT stands for Real Estate Investment Trust. So it's short for you can invest in real estate without actual buying the property. You trade it as a common stock on the stock exchange. And by law, they have to pay out 90% of the income, as it says here on the third bulletin. So yeah, and it's also can't be that easy for a regular person to invest in industrial properties or commercial properties, data centers. Maybe you can buy a residential and have some people buy renting, of course, but the other types are quite hard to come by. So it's a really great option to get into the real estate play. Also, I found a cool metric about, see if I can find it, the average investor, how they are doing. And when I was looking at that, I actually found out that REITs has been doing great the last almost 20 years. This is from JP Morgan, middle of June last year. So this is fresh data. And here we can see that commodities and cash is doing the worst. Average investor is actually only doing 2.9% return. That's horrible. 40-60 and 60-40 I think is referring to stocks/bonds portfolio. S&P 500, the 500 largest market cap in the US, 7.5%. High yielding stocks. Then we have small cap on 8.7. EM equity is most likely emerging markets, so places like Africa, China, so on. And then we have REITs at an annual return of 10%. So REITs actually, at least if you look at the history, has been a great investment. Being an average investor, not so great. So I'm just gonna take a look here. Yeah. Okay, so REITs has been great, and they tend to have a nice dividend yield. Hence, they are very interesting to us dividend investors. You don't have to be a landlord and deal with maintenance or messy people that are not gonna pay your rent. So yeah, it has its pros and cons, but to me it looks like more pros. But you don't have the same control, I guess, like if you own the property yourself. And I know in the US there are some extra tax on the dividends paid from REITs. But on the other hand, I think the REITs themselves, the companies, don't have as much tax, and but in regard of that, they have to pay out the earnings 90%. Oh well, let's start with Prologis. Prologis, I think we are going to use fast graphs mostly. I have a running subscription there for a month, trying it out. I really love it. So how fast graphs works is it will plot earnings and the stock price and the normal PE. And the PE is gonna be during a period. So example, if now we have VF Corp, we can do Microsoft. So for Microsoft, we can see if we look at a 10-year period, the PE is about 24. And the growth is about 70%, which is great. Not a high yielder, but just so we can see here, if you go to 15 years, the PE is gonna change. So it's actually accelerating. I can also adjust down here. So if I want to look at the later years, the P is going to be crazy, maybe 30. Yeah, 32. So it's grown a lot now since they made the move to cloud and subscription. So it's really worked out nice for them. So that is how the fast graphs works. And here we can see we can remove everything. And I think the most interesting is the actual earnings. How is the company doing? Then the price usually follows how the earnings goes. So here we can see now we are in a quite steep market, and yeah, it can drop quite a lot more before it comes back to reality. So how is the stream working, guys? Is anyone in here in the chat? Is the webcam okay? The mic okay? Don't be afraid to use the chat or do a stock request. Okay, so this is how the fast graph looks. And the blue line is the normal price of the stock. The yellow line is the earnings. And here we can also see the earnings in number down here, the first row, the earnings change, and also the dividend. All right, so let's start with Prologis. Was it PLD? I think so. I tend to go with 18 years. Why do I do that? Because I want to include the recession of 2007, 2008 to see how they are doing in recessions. And here we can see that it doesn't look really right, does it? And that is because you can also track on different metrics in fast graphs. That is why it's so cool for REITs. Hi James. KSS stock. Okay, let's do your request right away. And KSS is Coles Corporation. Hi Jeff. Okay, nice that it's working. So I will try to go with update. I have a notepad for the requests. Let's see if this works. Just checking it out. KSS, James, let's save that. Is it updating on the right? It should, yeah. All right, awesome. For the request, I was thinking doing the same format as I do with the quick videos, just to give you a quick score. So I'll actually open up my sources. I have put them all in a group. So source. And here we can see, what was it? KSS from James. And that is Coles. I start on Morningstar to get a bit more info on what sector and industry they are operating in. Morningstar doing a terrible job in this case for it. I can see that at least the market cap is 5 billion. Okay, it just read the data really slow. So the sector is consumer cyclical and the industry is department stores. I'm from Sweden in my 40s. I live on the west coast. Just a bit background. Been investing maybe for 10 years. Started a YouTube channel to learn more about investing, and I really like to have a fixed metric to evaluate all the stocks. So that's why I'm doing the videos. So for me, I'm not too familiar with Coles. I guess it's a large department store in the US, like maybe Walmart, but selling more maybe clothes and stuff like that. So yeah, market cap of 5 billion. I think it's on the verge of being in the S&P 500 maybe. And after that, let's take a look how the stock has performed. Then I use this from dividendchannel.com, a drip calculator. So we go with, was it KSS? My memory is bad now. KSS May, and I do it for usually 10 years and versus the S&P 500, which is SPI in this case. So here we can see that Coles actually has not performed that great the last 10 years with it, and this is with dividend reinvested $10,000. So during this period at least, the S&P 500 would be a much greater investment. But that doesn't mean it would be in the future. So if this company is growing and constantly maybe expanding, but they have to change the business somehow to get out of this slump, I would say. I don't take the stock price into consideration too much when doing the flashcards. So all in all, no points yet. After that, I also take a quick look at gurufocus.com, and they have an interesting page called GF value. And what that is Sheepman's variant of fast graphs. So basically it looks at the PE, the price to free cash flow, and also the estimates for the business. So if you go to this site, you can actually type in your ticker, and it will see for the historical price, and it will also make an outlook. So here we can see where the stock is trading now, about $43. The earnings seems to be very cyclical. Holy crap. I guess they got hit. Yeah, of course, being a department store, they got hit like crazy during the intense periods of the disease. And after that, it rebounded, but then it really doesn't know where to go. But might actually be in a fair value at the moment, so that's interesting at least. TXN, okay, thanks Jeff. I will add that in the document. Let's see if it shows up. TXN, if I don't remember wrong, is Texas Instruments. Jeff saved, so let's see if it pops up on the stream. Should do just any second. Okay, so now we have established the stock price and just a brief valuation. Let's take a look at some metrics, and for that I mostly use Finviz. So let's take a look at Coles. Finviz has a lot of data, and at least for me, for the 10 points I evaluate, I find the earnings of the company, the sales, is what really drives the stock price and what is most important. Then the price will fluctuate, the PE, the PEG, the price to book. But if the company is steadily earning money and growing its earnings, it will do great. And it will continue to do great if it also has high investment return on its invested capital. And that I learned from famous investors like Terry Smith from Fundsmith, and Charlie Munger also talks a lot about return on invested capital. And that is basically you give $100 to the management team of a company and they make 120 of it. Then you have a 20% return on invested capital. But for my first point, I look at the sales. You can have higher earnings by buying back shares or do better margins. But if your sales are constantly going down, you're gonna get into trouble sooner or later. So also increasing your sales, I think, is important. Coles is not doing that over the last 5 years, so 0 points there. Next up is the earnings for the past 5 years, and they actually increased it quite a lot. The threshold here is 8%, both for past earnings and estimate earnings. So Coles would get 2 points here. Next up, I look at return on invested capital. There is actually a number here on Finviz, but it's not over a 5-year period. I found that Morningstar actually has that number. So if you go to operating performance, which is a nice financial site, we can see a lot of performance numbers. How is Coles actually doing? And here we can see a return on invested capital year by year, but they are a bit sneaky. So if I click this and right arrow keys, I've actually found that they have a 5-year average return on invested capital. And here we can see that Coles has 7.72% return on invested capital over a 5-year period, which isn't great. I would say over at least 10% is a good return on invested capital. In the scorecards, I think I have 12%. So this would not be a check mark. Oh god, am I keeping track of the score? No check mark here. Nothing on sales. 2 on EPS. I probably should have written it down. Okay, so 2 check marks so far. Next one is debt to free cash flow, I believe. I also use Morningstar for that. You can use any financial site where they have a balance sheet, basically. So what is debt to free cash flow? It's actually how much total debt a company has divided by the free cash flow it generates. So here we can see, if we click balance sheet, we can also see assets over debts. But what I usually look on is total debt. And here we can see 6.79. So I'm going to do a bit of calculator here. 6.79 divided by, we go to cash flow tab. Free cash flow 1.67. Ooh, that's on the verge of being great, not great. Okay, so it actually 4.07. So if Coles keep on delivering these numbers, they would have a turnover of 4.07 years to pay off their debt with their free cash flow. And I would say this metric becomes more and more important now with the raising interest rates. I have a threshold or under 5 for this, so this would be a check mark. I think we're up to 3 check marks. I can actually, let's do like this. 3 of 10, I can write it here. Yeah, that would be good. Does that work? 3 out of 10. Yeah, okay. So I can keep track of the damn numbers. All right. After that, it's shares outstanding. And I use a site called sharesoutstandinghistory.com. Let's take a look at Coles, KSS. Hit get shares outstanding history. Wow. This is among the best, or at least the most, buying back shares I have seen in quite a while. Holy crap. Coles is buying back shares like crazy. So I look at the number 5 years ago. It had about 170 million shares outstanding. Now it has 128. Wow. So yeah, they are sure buying back a lot of shares. Good job, Coles. At least if they find that stock is undervalued. Buying back its own share when the stock is highly overvalued, of course, not a good deal. So a good management buys back its shares, or at least increase the spending for share buybacks when the stock price is down. And next up is the dividend metrics. So I go to Seeking Alpha for this one. Seeking Alpha is a nice site, but sometimes it misses on the dividends, especially the dividend growth years. So I'm just making sure we are at the calls. Yield is okay, high yield 4.13. So that's 5 out of 10. Payout ratio very low, only 16%. Here you want under 60-70%. That's 6 out of 10. The growth rate is negative. Ouch. Did they actually cut their dividend? Oh, okay. Yeah. They got hit so bad during the disease, so they cut their dividend. Quite uncommon with quality American dividend stocks. I've seen it quite a lot here in Sweden. They froze the dividends for a lot of companies. But yeah, okay, that's rough. They have to start over again with their dividend increases. So, okay. Only no dividend growth rate over 5 years and only 1 year for dividend growth. So Coles actually stops at 6 out of 10 points. It had not so good sales, earnings okay, but earnings gets boosted a bit by buying back that amount of shares. Because earnings is earnings per share, and if you remove and buy back a lot of shares, it will boost your EPS. All right, let's take a quick look also at the fast graphs for James on KSS, and I guess this would be quite cyclical. Holy crap, yeah. So let's go maybe 18 years. We get the recession period also. And we can see that growth during 18 years has been 5.3%. Usually say that the S&P 500 is going about 10%. So there needs to happen miracles with Coles for it to really lift off, because it has not been doing great. But also the stock price has not been doing great, and it's trading quite low. So if the estimators, analysts are correct, Coles might actually have a very bright future, at least for the stock price. If the stock price follows its normal value, I mean, it's hard to say what's normal for this very up and down stock price, but the normal PE is 12.58 during this period. And if the stock price follows that, you actually will have a 36% annual return. So this might be a nice value play, maybe for a shorter time period, 2-3 years. I wouldn't sleep tight holding this portfolio. I wouldn't class it as a forever stock, much regarding the poor historical performance. So maybe if they change their business strategy, management, somehow they can turn it around, maybe more. I don't know how much e-commerce they do, but Yeah, something like that. All right, that was Coles. Maybe we can do Prologis REIT in between, just a small look at what they do, and then we go with Texas Instruments. All right. So let's get back to this picture. Prologis. Industrial REIT, market cap 116 billion. Let's pull it up directly on Fast Graphs. I think we were at this stage. No worries, James. Hope you like the brief analysis. Anyway, here on Prologis, we are gonna go to adjusted funds from operation instead of earnings, because earnings gets a bit skewed on REITs, and it has to do a lot with depreciation. Usually in the balance sheet you put down your assets, but that doesn't work very well for REITs, because normally the assets actually raise in price. So you have funds from operation, also adjusted funds from operation, and for the adjusted funds from operations, you also take in capex from, like, if you have to repaint the house and basically the maintenance. So we can swap to this one, and here we can see that the graphs looks much more reasonable. And for Prologis, we have 17 years of data. We can see that it started out quite poorly. It launched at $51 down to 10. What a nightmare being that IPO. But after that it slowly started to climb, and now with this disease and the warehouse shortage, I guess it has just been booming like crazy. Holy crap. From 62 up to 170 almost. Yeah, that's crazy. Wow, what a ride. But yeah, what a drop also. I guess they did maybe reported earnings lately, and holy crap, yeah. But still, this needs to come down a bit to be fairly evaluated. Maybe interesting if we remove these poor years in the beginning. So how is the growth? 11-12%. I guess they had some troubles in the start of their journey, but after that it really took off. I actually seen an interview with the CEO, and he seems very knowledgeable, and they are doing a lot of training programs for new employees, and they discuss about how it's actually very expensive to automate and do robotics for warehouse buildings and such, and staffing is a huge problem for them. Okay, so nice growth, at least the last 15 or 14 years. The yield is 2.5, and we can go here, we can put everything on, so we can see here is the dividends. You can see how much is paying out. So they have to pay out about 90% by law, at least the taxable income. And we can see with the earnings growing like this, it can raise its dividend. We can take a look at Seeking Alpha to see how the dividend looks. And yeah, nice growth, semi-nice yield for REIT, but only 9 years of dividend growth so far. And what do we have more? can take a brief look at the corporate website. No, I guess not. Prologis, what did you call that? So yeah, mostly warehouses. Bit of diversification, America, Europe, Asia. So yeah, there you have it. Let's do TXN for Jeff. So let's see, we go 0 out of 10 in the small overlay I have here. Let's go with Texas Instruments. You can take a look, start at Morningstar. And for you who don't know what Texas Instrument does, they are a semiconductor manufacturer. I think they do a lot. They don't only do calculators, they do a lot of like analog to digital switches and chips. So it's not just making processors for computers. There are semiconductors everywhere. So in all these types of machines like toasters or fridges or wherever there is a chip, it might be Texas Instruments. I know that Qualcomm and Broadcom does more of communication chips with Wi-Fi and such. Hi Lasha, thanks a lot. Hopefully the sound and picture is okay. It's the first time streaming. Thanks for tuning in. So yeah, Texas Instruments, whopping 156 billion in market cap. Huge. And as stated before, in the technology sector and semiconductors specifically industry. Let's see how it has performed. Again, using dividendchannel.com to get a chart for the last 10 years. And we can see, like for almost all semiconductor manufacturers and makers in general, it has been booming years. I think it's only of the big one is Intel that has been lagging last couple of years. So if you invested $10,000 in Texas Instrument 10 years ago, it would be worth $79,400. The S&P would be worth 38. So yeah, double up the S&P. Good job, Texas Instrument. Good job indeed. How is the valuation? Has Texas Instruments dropped down as other tech stocks lately? Let's take a look. If we look regarding, maybe I can zoom in a bit, regarding historical PE, price to earnings, price to sale, price to book, and price to free cash flow, and also the future outlook, Texas Instruments is actually ranked as modestly undervalued. Hello Hamad, T-Row. I'm a bit biased actually. I have T-Row in my portfolio. So for me, T-Row is perfect 10. Last time I did an analysis of them. And so I like T-Row a lot. I would also actually take a look on BlackRock. That's even a larger investment bank. It might even be more stable than T-Row. Having both may be even the best option, but I think both T-Row and BlackRock right now could be potential great buys. Sorry, back to Texas Instrument. But here we can see that it's actually estimated to have a bit of a down period next coming years. So maybe it doesn't have the best future. Okay, so let's see for Infinvis how it looks for Texas Instruments. We start out with the sales. Oh Jesus, 14 point. Oh, that was quarter over quarter. Sorry. Last 5 years of sales. Let's zoom in a bit here also so we can see. Sorry. That should be better, right? Sales 6.5% increase annually the last 5 years. Great, it's a point for that. Threshold is 4%. Earnings per share past 5 years 18.9%. That's a big fat check mark. So then we have 2 points for Texas Instruments. Next up is earnings per share estimates, and they estimate about 10% earning the next 5 coming years also. So a bit of a slowdown, actually a lot of a slowdown, but yeah, still great earnings ahead. Hamad says analyst estimates aren't that good for Tiro. You think so? Maybe, maybe not. You can actually check in fast graphs. So if we type in Tiro, I think there is an options to see how analyst has been doing. So here we can see analysts has actually beat analysts 71% of the time, hit it 14% of the time, and only missed 14% of the time. So here we can see the estimate, and yeah, so it doesn't seem to be that far off, I guess. I'm not really sure how to read all this, but of what I can see here, there is a 10% margin of error, so that's not a lot. All right, back to Texas Instrument. The next one is after earnings is return on invested capital, maybe the most important metric. Okay, Texas is making tons of money on their investment. 35.81% the last 5 years. Wow, that's just amazing. They must have great pricing power and not so much competition in their area. They are really making a lot of money on their money. So that's a big check mark. 4 out of 10 yet for Texas Instruments. Next up, we can look at the financials to see if they can pay off their debt easily. Texas Instruments on the whole year last year had total debt of $8.12 billion, but they earned 6.29. Okay, so that is a big check mark. It just takes them a year, a bit more, to pay off their whole debt with their cash. That is actually very impressive. So big fat check mark also on debt to free cash flow. Next up is are they buying back shares? And with that earnings growth, I bet they are buying back a lot of shares. Yeah, they sure are. Also this, I tend to look at the 5-year average period. So 2017, the same period, they had about 995 million shares outstanding. And now 922. So nice check mark there. We're up to 6 out of 10 for Jeff's stock request for Texas Instruments. If you have any other requests, you can just put it in the chat and I will take a look after this. Okay, next up is some dividend metrics. Let's go Texas Instruments. We're looking at Seeking Alpha and we can see that the yield is 2.63%, which is a nice yield. It's over 2%. Not that under 2% wouldn't be a good dividend stock. It's just for it to a bit be categorized as a dividend stock. I mean, you have to draw the line somewhere, and you can say is a stock that is paying 0.1% really a dividend stock. I don't think it would attract that many dividend investors to generate the cash flow for them. Even if they are growing the dividend like crazy, let's say they raise the dividend by 20% per year, it's gonna take a lot of years for that 0.1% dividend to actually be something meaningful for a dividend investor. So yeah, 2.63, that's a nice check mark. 7 out of 10. Do we have all check marks so far? Could this be a perfect 10? Let's take a look at the payout ratio. Payout ratio is a bit up there, 48%. Hopefully they can sustain that. Hopefully it will be a chip shortage a bit further on. Personally, I don't think it's gonna slow down with demand for semiconductors. It might, I mean, they're building like crazy. Intel is building, Samsung wants to use Intel's chip making factories and so on. I know they are building a lot in Europe, but it's gonna take time. So I think for a couple of years, maybe 5, 6, 7 years, there's still gonna be amazing time for chip makers. Anyway, what was that? What's a 7 out of 10? 8 out of 10? I think it's 8 out of 10 now. Growth rate, 18.91%. That's actually amazing. I would say over 5, 6, 7% is great to get an annual pay raise and keep up with inflation. How often in your job do you get a 5, 6, 7% pay raise? Maybe for some of us, but probably not so much for the most of us. So that's 9 out of 10. And dividend growth, 16 years. Not bad. Not bad. So Jeff, congratulations, you picked 10 out of 10 on your first request. I think you have requested on the YouTube channel before, right? But I don't know if we can you get some exclamation marks. 10 out of 10. So nice pick, Jeff. Yeah, bro fist. Not too bad, not too bad. And let's take a look at fast graphs also. I guess you're interested in this. So for the valuation, Texas Instruments, how does it look? Okay, yeah, you requested S&P Global and Lind. Cool. I think I've already done both of those, so thank you for the request, and hopefully you like the result. Okay, how does it look for Texas Instruments? We have actually exactly 18 years of data, yeah, basically. So we can see it's not doing great in recessions, but that was, yeah, I mean, that was 2008, so it's quite a long time ago. I would say companies change, looking back further than 10-15 years, it might not be the same business anymore. But I would still say for Texas Instruments, it's a bit same business as before. Just it's growing like crazy. If we remove the lousy years of 2008, 2009, you can see, is it not updating? Oh, I have a free cash flow, that's maybe why. Okay. Sorry. I had I had the wrong metric from before evaluating the REIT. So we have gone back to actual earnings, and here we can see Texas is moving along very well. It's a bit cyclical. I mean, yeah, like the most stocks, I would say, in average. Also, average earnings growth about 9.8%. And I would guess the only worrying with Texas, as it being a 10 out of 10. So, I mean, the growth has been there, the balance sheet is good, they are buying back shares, the dividend metrics are great. But why are the estimates not greater than this? Here I would actually dig deeper and see, are they not expanding? Are they basically, why is it not going to grow better? Because from 2012 to 2021, the growth is like crazy. 14, 35, 10, 23, 25, and then the estimates goes down to only 1% or 2%. If we go to a 10-year period, we can see that if Texas would move along like its normal PE over 10 year, can I move this? Yeah, it would have an annual return of 8.5%. Annual. You can have some more numbers here. You can actually see 5.8 would be the actual return without dividends, but if you put dividends on top of that, it would be 8.5. All right, so yeah, it has come down a bit, but I mean not as much if you go with crazy stocks like Netflix or other tech stocks. Oh, Netflix, such a tragic top. All right, that was Texas Instruments. We can continue a bit with the other REITs. We did a bit of investigation on, what's it called, Prologis, on so much money tabs. We can actually go on one REIT that I have on my checklist, watch list, and that is American Tower. And why do I have that on my watch list? It's a hard word for me. It's because I want to diversify into REITs, and within REITs I also want to diversify. I like to own at the right price realty income. I already have realty income, but also in an industrial play, and that would actually be Prologis. And I think a combination of commercial REITs, industrial REITs, and American Tower would be a good REIT portfolio. American Tower are renting out telecommunication sites, like towers, for like 4G, 5G solutions, I guess to Verizon or AT&T and such. If we go with AMT here, and last time I looked at AMT, they had a steady growth, and actually high steady growth. We can see that the earnings is actually almost a straight line over the last 12 years. So I think this is very impressive. The valuation is still a bit steep, but if this comes down to, I guess, maybe the 210, 220 range, I'll definitely pull the trigger here. Very, very steady growth, very steady high growth. I think this type of sites that they are operating is not gonna go away anytime soon. I mean, the only maybe threat would be Elon Musk and his Starlink. What is it called? American Tower, isn't it like that? Yeah, so here we have it. So basically communication sites like this. And they have 221,000 global sites. And it's not like when they have companies renting these, it's not like they say, okay, we're not gonna rent this from you anymore. We don't want coverage in this area. I mean, this has to be extremely dependent on this type of sites. So yeah, I know that Bill Gates own one of their competitors. I think it's Counsel, yeah, this one. I looked at it also, it has a bit more yield. They seem quite similar, to be honest. But when and we can also take a look at Seeking Alpha, AMT. So we can see nice yield, payout ratio should be up there. Nice growth rate, and they have been growing the dividend for 10 years. If we compare it to, I guess, one of their competitors, the Crown Castle, CCI, we can see that, let's take a look here, Crown Castle, bit high yield, payout ratio seems a bit iffy, take a look at that. Not growing in the dividend as fast, of course it has a higher yield already, so that's natural. Let's take a look at Crown Castle in fast graphs. And we can see, yeah, I mean, it also has a very nice steady growth. Bit higher yield, so yeah, might actually have my eyes on this one also. Let's see if the corporate web, it's not working for this either. Crown Castle, I'm pretty sure they are also operating communication sites like AMT. Infrastructure solutions, Ethernet, fiber, towers, small cells. Yeah, and also a lot of fiber. Let's see if they say how many sites they have for their towers. I mean, can they go a deeper dive into that if you like? Wow, an hour has passed already. So I guess we maybe continue with the rest of the REITs next time. This has been a lot of fun. Thanks for the request, James and Jeff. And yeah, I think we're gonna continue with the rest of the REITs on the next stream. I saw there's a lot of question about REITs on the YouTube channel, so that's why I wanted to do a bit more dig deeper into them. Can we hi Lasha, can we do for F and Rivian your thoughts about it? Okay, sure, we can do a short one. F, I know, is Ford Motor Company, and I have looked at them before, but to be honest, I tend to avoid this kind of sectors. Communications, transport, commodities, and big telecom are sectors that are very, very, what should you call it? Basically, it's doing poorly in terms of invested capital. I'm gonna see if I can find the picture from Fundsmith. Let's see here. Yeah, I think this is it. How do I do this? Maybe like this. So here you can see. So these are the sectors with really, really low return on capital. So transportation, telecom, utilities, energy, and materials all have under 10% for, yeah, I mean, it's not only decades, almost a century. But especially for Ford, we can see if we type in F Ford, we can see quite fast that this is, if you're going to take a gamble on Ford, it's not because you want a nice quality dividend stock company with all the check marks for sales, growth, buying back shares. Basically, it is not a quality company like that. Ford, I would buy if it dropped way, way, way down for its valuation and nothing else. I hope that makes sense when you see how cyclical it is. We can go to earnings, then it should show a bit more of the picture. But here we can see they also cut their dividends for many, many years. It's basically not a stock to count on at all. It's going up and down like crazy depending on EV, management, CEO, different takes on where to take the business. And I mean, if you bought it back here 2002 and held it to now, you would have made $0. So yeah, that's for Ford. I'm sorry if it's disappointing, but it's not a quality company, not at all, in a dividend quality point of view. I know there are some other car manufacturers that have a bit more quality, like I think I looked at maybe Honda or such, and I can tell you right away that I don't think Rivian is actually doing any dividends yet, are they? Yeah, I mean, it's such a fresh company. I think Rivian, both Ford and Amazon has stakes in Rivian, but they sold off some lately. So Rivian is purely a dice roll. You should only see it as a dice roll. And not that I should make investment strategies or recommendations for you, but if I were you and I was thinking about Rivian, I would put a tiny amount of my portfolio in there just as a bit of a gamble. So I hope that answers your question somewhat, Lasha. And thank you so much for this time. I can feel my throat actually starting to ache a bit. I'm not used to speaking constantly this long, but thank you so much for joining the stream, and I will definitely do more of these in the coming future. I don't know exactly when, maybe once a week or one every fortnight. But yeah, thanks for tuning in, guys.